to be settling. Now, Gautam Trivedi joins us. Let's take our conversation forward. Let's understand what his view on the market is. Gautam, good morning. Thank you for joining us. Gautam, how would you characterize the market picture for us? You got 5 big brokerages based on data and based on historical averages, which are now making a claim that the best of the year is behind us. It's time to go easy on Indian stocks, and we could be in for an earnings downgrade rather than an earnings surprise.
Sure. I think let's look at the ingredients that have actually caused the Nifty 50 to rise as much as 140% and more since the lows of March of last year. Unfortunately or fortunately, all of those ingredients are pretty much in place. I mean, that hasn't changed. Low interest rates, global liquidity, not to mention liquidity in India itself, easy access to the markets, i.e. via your smartphone, 450 million to 500 million smartphones in India, new folios being registered every single day, eKYC, zero commission brokerages, and broadband speeds. I mean, that hasn't changed. So where you saw last year, 2020, foreigners and FIIs basically driving flows into the market and causing the market to rally 80% from the bottom. This year, it's been the local investors. So I think that trend, I don't see getting disrupted anytime soon. There is one thing, however, I must mention that has changed, is the fact that people are starting to come back to work. So the work from home culture is starting to get diluted. And even in our case at Nepean Capital, we are now working from the office 4 days a week. So what does that do? For people who are not in the financial industry and who were trading the market, it was easy to do this from home because you don't have your boss looking over your shoulder and saying, what are you doing? You should be working versus trading the market. That culture, to some extent, will have an impact, but I don't see at this point of time a significant reason for a correction in the markets.
But when data has been thrown at you, which is based on hard facts, the Sensex P multiple is 50% higher than historical averages. Margins will remain under pressure because of high energy cost, which account for almost 25 to 40% of the cost. And energy cost is like imported inflation because we are still net importers of energy. When data has been thrown at you, which claims that when good quality stocks have reached P multiples of 50 times or 70 times or even 100 times, future returns are compromised. How would you ignore that?
No, I think all that you said is absolutely true. Even in the US, I mean, if you go back to the biggest market in the world, the United States, equity holdings now make up for more than half of the 109 billion of financial assets that households own. And that's a 70-year high. So clearly, a lot of records are being broken, whether it's in India or overseas. So I'm not even getting back to that. I think the fact is that I don't see a major correction happening. Frankly, we've launched a new fund. So if there's a correction, I'll be the happiest person if there's indeed a correction. But I don't see a major correction happening for the reasons which I entailed. The other thing to keep in mind, if you look at the BSE 500, some degree of correction has already started to happen. And let me explain. So if you look at 225 stocks of the BSE 500 have already corrected 15% or more. So if you look at the headline Nifty, that is in a different zone in some sense. But if you look at the broader market, there's some degree of correction that's set in. Apparently 100 stocks have corrected more than 25% from their 52-week highs. So when you start adding this up, there is some correction already underway in the markets, which is not visible if you only focus on the key indices.
Sure. So Gautam, wanted to understand where exactly do you see the profit pool increasing from here onwards?
You mean where do I see potential areas of growth, you think? Hello?
That's right, Gautam.
Yeah. So I think there are sectors where, let's not look at the absolute stock price, but let's look at earnings for a minute. I think there are sectors where clearly there is significantly more momentum. Financials, real estate, I mean, these are the two sectors that we are actually quite bullish on. And add to that, of course, is cement. And we discussed, I think you were discussing earlier about some disappointing numbers because of raw material cost increases. But I think that will start to even out over the next few quarters. So these are the three sectors that we actually are pretty positive on.
Right. When one looks at the tech companies, Gautam, and especially in light with the dhamaka that the Nykaa IPO turned out to be, and then today you've got Policy Bazaar's list and Paytm as well, hopefully at the end of the week. Just wanted to understand, where is it that you stand in terms of the IPO euphoria, as some on the street seem to be terming this as?
Yeah. That's a very good question, Aisha. And I tell you where I see a couple of issues with the new tech companies. First and foremost, let's not forget the valuation metrics for India's new tech companies, whether it's Zomato, whether it's even IRCTC for that matter, Nykaa, and of course, as the other ones that will soon list, you mentioned. They are driven by the valuation metrics of another country, which is the United States. So the question really is, how long will Indian investors who've been traditionally used to seeing companies having not just EBITDA profit, but even net profit positive, how long will they tolerate these losses? So if you look at Zomato's second quarter numbers, for example, yes, revenues were up 145%, very good. But guess what? EBITDA loss actually doubled, and adjusted EBITDA loss was 311 crores. So there is, as of now, and I've said this before as well, that it's been now over 3 months that Zomato got listed, and you've seen the market cap sustaining above 1 lakh crores. Nykaa is already above 1 lakh crores. Question is, how long will this sustain? So that's one. The second issue that I have is, with the exception of Nykaa, if you look at all the other new tech companies that are IPOing and have already gotten listed, there is the majority of the owners are actually private equity funds or venture capital funds who are exiting via an OFS. So as a result, the founders, again, unlike Nykaa, where Falguni Nayar owns more than 50%, the founders of these companies are actually down to a single digit in terms of shareholding. So question is that you'll see a continuous supply as the investment horizon for a lot of these VCs and private equity funds is actually finite. Unlike a traditional company where you have institutional investors who own stocks for 10 to 15 years. I mean, people have been owning HDFC Bank, for example, for over 20 years and have done extremely well. So I think these are some concerns that I clearly have. But having said that, I think new tech is here to stay. It's going to be an integral part of our economy. It's going to be an integral part of the Nifty 50 at some point of time. And if you already see MSCI has included IRCTC and Zomato as recent as the end of this month. So as a result, I think new tech is here to stay, but valuations will have an impact at some point.
Good morning, Gautam. So just building on that point, where you're saying that obviously tech companies are here to stay. We have to watch out for their valuations, the PE multiples. The opportunity also is to find in existing companies that are getting digitized, are trying to be the transformers, and not just by hiking their IT budgets. From that wave, who would you bet on?
I'd bet on Bajaj Finance. That's the poster child for the NBFC industry, and I think this is one company that's going to reinvent itself as a digital company. So that would be my number one choice.
Your number one choice of Bajaj Finance. It is, of course, coming out with a platform, an integrated platform, which is going to be tying up healthcare with insurance and this, that, and the other. It's also being seen as an early pioneer for buy now, pay later, so that it didn't call it that. It's interesting times ahead. Gautam, you're talking about betting on real estate as well and the financials. One can't help notice that this earnings season, last earnings season, the poster boy was clearly IT. That hasn't happened this time round. Even though the numbers are rock solid, maybe it's the base effect at play. The churn that we've seen post the earnings season, are you saying after that is the financials and the real estate which will come out on top?
Yeah, just on IT for that matter, the question that have been asked often, and a lot of investors ask me the same question on IT, that now you've got TCS at 29 times, and isn't that ridiculously expensive? And I said, well, I think if you look at how the IT companies have done over the past about 3 to 4 years, they've clearly reinvented themselves. They've gotten into new verticals, whether it's cloud computing, whether it's AI, whether it's 5G. And the fact is, these companies, are run by extremely smart, intelligent people. And when they see an opportunity, when they see that the traditional businesses are slowing down, they're quick to respond. And as a result, that's the reason you've seen that re-rating happen. So maybe a TCS at 29 times FY23 PE could be potentially the new normal. So that's one. Specifically on real estate, I think given the amount of money that's been made by retail investors in India, and especially this calendar year, you'll start to see people taking profits. As I mentioned, some stocks have already started correcting from their 52-week highs, which means somebody out there is taking a profit. And as a result, you will see that money, as it happens in every bull market, come into the property market. And I think if you look at the last 7 to 8 years, it was a disaster for the property market, which is now finally to come back with a bang. I recently met with a large dealer of marble and granite in Western India. And he said he hasn't seen this level of business in the last 9 years. So clearly, that's an indication of how fast the property market's coming back. Moreover, if you look at the second quarter results for a macro tech, a record up 88%, Soba, which had its best ever volumes for the second quarter. So you're starting to see now that sector emerge. And I think one of the best places to play it is actually cement.
Soni? Go on that note, good chatting with you as always.
Thank you. Thank you.